Okay, so you want to own a data center. A windowless steel building humming quietly on the edge of town, packed with servers that never sleep, running an internet that never stops growing, generating rent checks from tenants who never leave because their entire business now lives inside your walls. You picture the ultimate landlord business. No toilets to unclog, no tenants complaining about noisy neighbors, just racks of silent machines paying you every single month like clockwork. Sounds simple. It is not simple. Here is what nobody tells you before you break ground. The building itself is almost the cheapest part of the entire operation. The real currency in this industry is something you cannot manufacture, and one of the most aggressive data center operators in America filed for bankruptcy, carrying nearly $900 million in debt after betting everything on a single volatile source of demand. So let us take apart what actually happens when you own a data center. Let us start with the number that separates this business from almost everything else on this channel. Standard data center construction runs $7 to $12 million per megawatt of capacity, and AI-optimized facilities with liquid cooling and denser server racks can blow past $20 million per megawatt. On a square footage basis, that translates to somewhere between $600 and $1,100 per square foot. And at the extreme end, fully AI-optimized builds can exceed $1,500 per square foot, several multiples above almost any other commercial property type. Electrical infrastructure alone, the switchgear, the transformers, the uninterruptible power supplies, consumes 40 to 45% of the entire construction budget. And cooling systems eat another 15 to 25% on top of that. This is not a building in any traditional sense. It is closer to a purpose-built power plant that happens to have a roof over it. But here is the invisible asset that dwarfs every line item in your construction budget, and it is not concrete or steel. It is grid interconnection. Utility interconnection and power availability alone can represent $5 to $25 million depending on how close your site sits to existing high-voltage infrastructure. And sites with adequate power already available are becoming increasingly scarce in every major data center market. Some developers, unable to secure enough grid capacity, are now investing $3 to $10 million per megawatt just to build their own on-site power generation, whether that is natural gas turbines or solar arrays, simply because the regional utility cannot deliver enough electricity fast enough to meet the timeline. Add land acquisition costs that jump 23% year over year as developers chase ever larger parcels for campus-scale builds. Add specialized permitting for high-voltage electrical work that can take months to clear, and add a construction timeline stretching 18 to 36 months for anything beyond a small enterprise facility, and you begin to understand why this industry treats a signed power purchase agreement as more valuable than the deed to the land itself. Tier level compounds every one of these numbers further, because redundancy is not a marketing term in this industry. It is a design requirement with a direct dollar figure attached. A Tier 1 facility with no redundancy runs roughly $11,500 per kilowatt, while a Tier 4 facility, fully fault-tolerant and capable of surviving any single equipment failure without an outage, can push past $25,000 per kilowatt, with each step up the tier ladder adding 15 to 25% to total construction cost. Choosing your redundancy level early is one of the few decisions in this entire process that is genuinely reversible only at enormous expense. Because retrofitting a Tier 2 shell into Tier 4 compliance after the concrete has already been poured is dramatically more expensive than building it correctly the first time. So the facility is energized, the racks are humming, and now the daily grind of keeping this business alive begins. Because a data center carries one of the most extreme fixed cost structures of any property type in commercial real estate. This is operating leverage in its purest, most literal form, measured in kilowatt hours instead of customer visits. Electricity alone accounts for 40 to 60% of total operating costs, And cooling systems consume 30 to 40% of total facility energy on their own, because keeping thousands of processors from overheating is a full-time, 24-hour engineering problem that never pauses for a slow business quarter. Large facilities run $10 to $25 million a year just to operate. And even mid-sized facilities land in the $200,000 to $500,000 range annually, none of which cares whether your servers are running at 10% capacity or 90% capacity that month. The industry measures this efficiency obsession through a single metric called power usage effectiveness, or PUE, the ratio of total facility energy consumed against the energy actually reaching the servers doing useful work. A best-in-class hyperscale facility runs a PUE around 1.1, while an older, inefficient building can run 1.6 or higher. And that gap is not a rounding error, it is real money. Every tenth of a point of PUE adds roughly $50,000 a year in power costs per megawatt. Across a 50 megawatt facility, running an inefficient PUE compared to an efficient one, that gap alone can cost over $10 million a year. Money spent purely cooling wasted heat rather than running productive servers. Layer on labor, 20 to 25% of operating budgets, with skilled network and facilities engineers earning $70,000 to $150,000 a year. Layer on maintenance contracts for generators and uninterruptible power systems that must stay perpetually ready for a grid failure that might never come, and you have a building where nearly every single cost ticks upward on a fixed schedule that has almost nothing to do with how much revenue is actually walking, or in this case, streaming, through the door. So how does anyone actually turn a profit running a building this expensive to feed? This is the popcorn business moment, and in data centers, it is disguised as a technical metric most customers never think to question. When a colocation operator sells you space, they typically quote a base rate in dollars per kilowatt per month, running anywhere from $90 in emerging markets to over $220 in constrained markets like Silicon Valley or New York. And on top of that rate sits electricity itself, billed as a pass-through charge on your actual metered usage. Here is the part that never appears on the sales brochure. The operator buys that electricity wholesale and resells the underlying capacity at their quoted rate, which means the entire spread between the facility's actual PUE-driven power cost and what the tenant is billed becomes the landlord's margin, completely invisible to a customer focused purely on uptime guarantees and service level agreements. And that is only the beginning of the real profit engine. Cross-connect fees, the physical cables linking one tenant's servers directly to another tenant's network inside the same building, run $50 to $500 per connection per month on a cable that costs almost nothing to install and maintain once the fiber infrastructure already exists. Smart hand support, meaning a technician physically walking over to reboot a server at 2 in the morning bills $75 to $150 an hour for work that takes minutes. Why would a tenant accept these markups without blinking? Because once a company's servers are physically installed inside a facility, migrating to a competitor means weeks of downtime and enormous technical risk, which means the actual floor space and power capacity function almost like a loss leader used to lock a tenant in, while the recurring fees layered on top of that base rate, the electricity spread, the cross-connects, the interconnection ecosystem itself, generate the real, durable margin year after year. Now here is the trapdoor under the floor, and it is the single input every operator in this industry depends on completely while controlling almost none of it: power availability. A data center's entire revenue potential is capped by how many megawatts the local grid can actually deliver. And that number is set by utility companies and regional grid operators on their own timeline, not yours. With interconnection queues in the most desirable markets now stretching years rather than months. An operator can have fully signed tenant leases, fully approved permits, and a completely built shell and still sit generating zero revenue because the utility cannot physically energize the site on the schedule the business plan assumed. This is a risk no individual owner can engineer their way around because you cannot negotiate directly with the laws of electrical grid capacity the way you might negotiate a lease rate with a tenant. Layered directly on top of that grid dependency sits a second, equally dangerous risk: demand concentration tied to a single volatile use case. Data centers built specifically to serve one narrow customer type, whether that is cryptocurrency mining, a single hyperscale tenant, or a speculative AI build-out, inherit all of that customer's underlying business risk. And when that specific demand collapses, the specialized infrastructure built to serve it often cannot be repurposed quickly enough to avoid a severe cash crunch, leaving an owner holding enormous fixed power and debt obligations against suddenly worthless capacity. There is a third dimension to this trap that has grown sharper in recent years: the risk of building for a demand curve that never fully materializes. The current wave of AI-driven data center construction assumes a specific trajectory of compute demand continuing to climb for years, and enormous sums of capital are being committed today against facilities that will not be fully energized and leased for 18 to 36 months from now. If that demand trajectory bends even modestly below what today's business plans assume, whether through a slowdown in AI investment, a technological shift that reduces compute intensity per task, or simply a broader economic downturn, the industry could find itself holding a wave of newly built, heavily leveraged capacity with meaningfully fewer tenants willing to lease it than the original underwriting assumed. Let us talk about Core Scientific, once one of the largest publicly traded Bitcoin mining data center operators in North America, running 8 facilities across 5 states with over 800 megawatts of total capacity. The company went public in early 2022 through a SPAC merger and aggressively expanded its physical footprint, launching 3 new Texas data center projects even as the broader crypto market was already showing signs of serious strain. Prior to 2021, Core Scientific's power costs tracked relatively low alongside cheap natural gas prices, and the business model looked deceptively simple. Run thousands of specialized mining machines around the clock, consuming roughly 1,449 kilowatt-hours of electricity to mine a single Bitcoin, and sell the resulting coins for a healthy margin over that power cost. Then 2 forces the company could not control converged at once. Bitcoin prices collapsed through 2022 as the broader crypto market entered what the industry called crypto winter, while electricity prices simultaneously spiked, compressing the exact margin the entire business model depended on. Rather than hedge against falling Bitcoin prices or slow its expansion, one major creditor later described the company's strategy as an aggressive, ill-conceived push to keep building power facilities and expanding its mining fleet while never selling Bitcoin on hand and never hedging against a price decline. That decision forced Core Scientific to sell over 9,000 Bitcoin in April 2022 at a significant loss just to raise cash. By the third quarter of 2022, the company posted a net loss of $434 million, compared to a loss of only $16.6 million the year before, and admitted in a regulatory filing that it did not have enough cash to survive through 2023. Carrying roughly $879 million in debt at 2.5 times leverage, with its stock down 98% for the year, and market capitalization collapsing from $4.3 billion to just $78 million, Core Scientific filed for Chapter 11 bankruptcy in December 2022. The company eventually emerged from bankruptcy in January 2024 after restructuring roughly $400 million in debt and pivoted its entire remaining power capacity away from commoditized Bitcoin mining toward high-density colocation for AI workloads, essentially rebuilding its business around the exact power and physical infrastructure it had already built, just pointed at a completely different customer. The lesson is not that data centers are inherently unstable. The lesson is that a facility built to serve one narrow, volatile source of demand, financed with heavy leverage and no hedge against that demand collapsing, can turn a multi-billion-dollar company into bankruptcy court in under a single year. Let us run the numbers on a modest 10-megawatt colocation facility. Optimistic scenario against realistic bad year. In the optimistic scenario, your facility runs a strong PUE around 1.2. Your tenant base is diversified across enterprise and cloud customers rather than concentrated in one volatile industry, and your colocation rate lands around $130 per kilowatt per month in a solid secondary market. At full contracted capacity, that generates roughly $15.6 million a year in base rent alone, before electricity pass-through and cross-connect revenue, and against a construction cost around $100 million for 10 megawatts, disciplined operations can produce net margins in the 25 to 35% range, supporting a payback period in the 8 to 12-year range, typical for infrastructure-grade real estate. Now, the realistic bad year. Grid interconnection delays push your facility's full energization back 18 months past your original business plan, meaning your fixed construction debt is accruing interest on a facility generating zero contracted revenue during that entire delay. Once operational, a major anchor tenant representing 40% of your contracted capacity, exposed to its own volatile end market, defaults on its lease, and releasing that vacated capacity in a softening market takes months at a lower rate than your original contract assumed. Electricity prices in your region spike due to regional grid strain, compressing your PUE-driven margin exactly when you need it most, while your fixed operating costs, the maintenance contracts, the skilled labor, the standby generator readiness, do not move by a single dollar. Net profit margin can compress from that comfortable 25 to 35% range down into the single digits, or in a genuinely severe year involving both a major tenant default and a grid delay, into an outright loss. The difference between these two scenarios on a 10-megawatt facility can easily exceed $5 million in a single year, and on a business already carrying 9-figure construction debt, that swing is precisely the kind of gap that turns a comfortable debt service coverage ratio into the exact conversation Core Scientific's creditors were having in the fall of 2022. So what is a data center once you strip away the humming servers and the windowless steel walls? It is a machine that turns scarce electrical grid capacity into a recurring subscription, sold to tenants who have no realistic ability to walk away once their infrastructure is physically installed inside your walls. The building itself is almost incidental, a shell engineered specifically to move enough power and pull enough heat out of a room to keep someone else's servers alive. The real business is not renting square footage. It is controlling access to a genuinely scarce resource, megawatts of grid capacity, in a world generating more digital demand for that resource every single year than utilities can physically deliver. You are not really buying a windowless building full of servers. You are buying a bet on a power interconnection queue, a tenant's business model, and a grid operator's construction timeline, none of which you actually control, and all of which can determine whether your facility becomes a cash-generating annuity or an expensive lesson in exactly how concentrated risk can be.